Hey, everybody. Welcome to Let's Talk Markets Live. It is September 15th, 2025. Really happy to be joined for a macro markets episode by Ophir Gottleib of Capital Markets Laboratory, Claudia Sahm, Bloomberg opinion columnist and chief economist for New Century Advisors. Claudia, Ophir, thank you so much for joining us. Always appreciate you taking the time and the insightful conversations.
Thanks for having us.
Yeah, happy to be here.
We've got markets continuing to log record highs. Doesn't seem to matter. The jobs report, inflation, Fed independence under threat. None of this seems to matter. The markets continue to go up, all lines up and to the right. So again, they're doing the same thing today. So, we've got meetings coming up. The Federal Reserve is going to meet this week. And then Fed Chair Jerome Powell will make an announcement regarding interest rates on Wednesday. Cuts seem all but inevitable. And so we're sort of just wondering how big and how many cuts we're going to get this year. And we're going to spend some time on that. But first, thought we'd dig into the economic fundamentals from last week. And Claudia, I'm especially interested to hear what you think of the jobs report, what you think of the revision. So BLS showed that 22,000 jobs were added to the economy, which was less than 75,000 that was predicted. The unemployment rate is up to 4.3%. They also revised earlier months job data that they said revised them down by 911,000 jobs over 2024 and 2025. So, this has all happened subsequent to President firing the BLS commissioner after similar downward revisions. So where do we even start here? What's going on in the jobs, with jobs in the U.S.? What do you see when you see these numbers?
Right. Well, what we've learned is that job creation in the United States has really slowed to a crawl. So in the last 3 months, the average new net jobs created were a little under 30,000 a month, out of, almost 160 million workers. Like, that's a really small monthly increase that's happening right now. So that, and we got a first glimpse of that in not the latest jobs report at the beginning of this month, but the month prior, because we got a weak reading, and then May and June were big downward revisions. That employment report was what cost the BLS commissioner her job, because it didn't please the president, the numbers. But we got a confirmation in the latest jobs report that, in fact, job growth has slowed. Now, the unemployment rate has moved up in the past 2 months, but has ticked up. Right. So in this period that we had job creation really, screeched to almost a standstill, the unemployment rate's risen, but hasn't skyrocketed, which gives a sign that there's more going on under the hood than just like, the labor market's falling off a cliff. There's, a recession is nigh. It's more. There also appear to be some structural supply side factors. Immigration is one that's gotten a lot of attention. Starting last summer, we went from having a surge in immigration into the country, particularly unauthorized immigration, to really pulling back, slowing that immigration that started under the end of President Biden. And then this year, particularly the unauthorized immigration has basically stopped. There have been deportations. I think another thing that's been really important is you've had hundreds of thousands of people who are on temporary status in the United States have their immigrant status revoked. These were temporary programs, kind of to give people from certain countries an opportunity to stay here. But with that, they lost their work permits. So we've had a lot in the immigrant labor force that's really dropped off, or at least dropped off in I think probably official measures. I think there's a question exactly what's happening with some of these workers. And then also we have, the baby boomers are in peak retirement age. I mean, we've got a slowing labor force. I think maybe a message, these latest jobs numbers, the payroll numbers were pretty jarring. And I think the message is we need to get used to these. Like, we're going to see some pretty low job growth just because these supply side aspects. This preliminary estimate of the benchmark revision, which has always been a super wonky thing, but for 2 years running has been a real, newsworthy event. That told us that job growth, it downshifted last year. And we had a sense of that, like payroll slowed last summer, and that was part of what got the Fed in their first of the cutting cycles. But it was even more than we thought. So again, I think it's this, like, there's something structural. These are really low numbers, and yet, last thing I'll say is, once you get these job numbers as low as they are, we're in a more vulnerable place, right? So I think, the risk, while a recession is not my base case, I think the odds are elevated. I think they're more elevated given how low the job growth is. But that's, and that is what will be the big motivating factor behind the Fed starting to cut rates again, is just they're concerned about that downside risk to employment getting out of hand.
And also the initial, it's just weekly, but the last weekly claims number was also surprisingly large. Also, it just weekly, but just pointing that out.
Yeah, I think the one with that is, since it was concentrated in Texas and they have a temporary program for floods, and it's okay. But at this point, like, you're looking for these crumbs because we know someone has a recession indicator with her name on it, but like, you're looking with the labor market, when it starts to go, it's like it's going to be subtle. Like, there's small changes and then it builds momentum and then it's totally out of hand. So it is absolutely appropriate to be watching the initial unemployment insurance claims for signs of weakness, and the fact that now we're seeing it in various pockets, like the payrolls have slowed substantially, the unemployment rate is ticking up, seeing something in claims, even if it's overstated in the date, it's still something there. So yeah, there's just the last time the Fed met, not even 2 months ago, it was the labor market's resilient, we can wait, like this is just, and it's, that narrative is turned on its head because we've just gotten an avalanche of data in the interim. This is, whoa, this is not, it's not as strong as we thought it was.
Yeah, and I think that there have been, I've seen lots of discussions about how the unemployment and the jobs figures are really being impacted by immigration policy. And yet, Ophir, I thought in your notes that you sent over ahead of this, that the idea that tariffs are playing a major role here is pretty fascinating. Why don't you go into what you were talking about there and talk about why, we're not necessarily seeing the inflation we thought we would from tariffs, and we're not seeing companies, we're not seeing margin compression or profitability reduction dramatically like we thought we might see.
I think we are seeing the inflation that I expected. I didn't expect it to be a lot, but I expected it to be meaningful. In other words, the downward trend has stopped, and maybe there's an upward trend, which, but yeah, I was preparing for this and I was just reading FactSet's data. Revenue for Q2, S&P 500 came in above estimates. So that's good, right? 6.3% versus 4.2% estimates. Again, those estimates came in on June 30th. So the closing of Q2, and then we actually got results. Okay. But EPS came in at 11.8% growth versus 4.9% estimates. So a little bit of by the way, that's why the market's at all-time highs, I think, because the Fed's cutting and earnings are at all-time highs. I don't think it's, you could say the market should be a little bit more forward-looking, but earnings growth doubled or tripled estimates, and the Fed's cutting is a pretty good reason, for the market to go up. But the question is okay, how did that happen? Well, if you beat revenue, then there will be that extra boost to margins. That just always happens. Right? Like that extra revenue doesn't carry a lot of that other crap that, it's above and beyond operating expenses, right? But not at that magnitude. And then you look at ISM manufacturing data, where employment is in contraction, prices are in expansion. And then you get these comments from people. They're like, yeah, we're not hiring because of tariffs. And then you get an ISM non-manufacturing, aka services, the exact same thing. Exact same thing. Employment is in contraction. It's a diffusion index. So any number before 50 is contraction, any below 50 is contraction, any number above 50 is expansion. Prices are in expansion, but employment is in contraction in services as well. And the same thing. People are saying, it's tariffs. So what are they doing? What are companies doing? So how are margins up, but there are tariffs? I think companies are just hiring less. They don't have to lay people off because we have various estimates that 80,000 people a week are retiring, age about 4 million people this year. So the unemployment rate, as Claudia noted, shouldn't necessarily, if this is the case, go up that much because people are just falling out of the labor market. For people who don't know how it works, right? If people fall out of the labor market, the unemployment rate doesn't get worse. But in ADP, we got quotes that people saying we're not hiring because of inflation. ISM manufacturing, ISM non-manufacturing, we see margins substantially higher than revenue. It looks like inflation is causing less hiring, new job creation, right? Less demand. But the supply is going down too because of this demographic shift. So the unemployment rate will look relatively unscathed, hopefully. But yeah, the economy's, the labor market has gone from like, everyone was calling for recession, and the thing you always finish that with was like, yeah, but the labor market's strong. And it's like, nope. Turns out it wasn't. And actually, as Claudia pointed out, like these annual revisions are usually go pretty ignored. And like the last two have been huge. It was actually, I think wasn't it 800,000 the last time? Something like that. Mm-hmm. And then it gets revised and revised. It won't end up being 900,000. It'll be less. But back-to-back big ones. But margins are going up. Feels like, and prices are going up. It feels like inflation is causing companies to hire less. It doesn't look like there's a ton of layoffs. I don't think this is AI driven. Not yet. I think that's coming, but not yet. And then you say, well, what about the CapEx? Sorry, Claudia, what about the CapEx? The CapEx that's being spent in tech is not labor. It's capital. It's equipment. It's not labor. So that $1 trillion that's getting spent is not for jobs. So that's my view as of today, based on going over all of the survey data. That's it.
Yeah, and I think that when you talk about the effects of tariffs on the labor market, I mean, we've had endless discussions of, the tariff, the costs will get passed through to consumers with prices, and it's temporary or transitory because it's a price level effect. Like you've got this extra cost coming from tariffs, so you pass on enough to cover that cost, and then once you've covered the cost, the inflation goes back down because it's a price level adjustment. So I've been kind of thinking about in the space of workers, because like the big thing is now we have this job growth that has slowed to almost nothing. Where does it go from here? Right. The bad risk is it just keeps going down and down, and then we're in a contraction. Or it could be, and I think the administration had tried to make this argument with the first kind of dismal jobs report. Oh, there'd been all this uncertainty in the spring that had been weighing because of tariffs, and that was weighing on, people weren't hiring. And now we're like, the tariff policy is being, I'm not sure it's like more certain. I think we're just dealing with the uncertainty, but then maybe that like hit to job growth will ebb away. Or if the way that businesses are covering the extra cost of tariff is by like not doing a chunk of hiring, like the level of the workforce, well, it could be like the temporary inflation effect, the temporary job growth effect. Like when you get to the other side of it, they've adjusted for that cost, and then job growth can pick back up. So I've been trying to kind of think about like because that's the big question. We can, 20,000 a month job creation against the right backdrop. That's just a slower structurally growth economy. It's not necessarily like a cyclical bad thing. It's where does this go? So I think it is an interesting how, it does look like companies have held on to some of these tariff costs, at least temporarily. And as you said, it's not hitting their margins.
No, which means something's going down. I will also say this, just because we might as well make it as complex as possible. It's possible that, okay, so the goal of tariffs, okay, other than bringing money in, which it's doing, and never mind maybe the negative, is definitely bringing money in.
Mhm.
The goal was to onshore some parts of our supply chain that just critically could not. We learned in COVID, we're like, oh, we can't do that, right? Maybe there's a rebound in job growth because of onshoring later, so soon. I'm just throwing things out there that are possibilities.
It has to be later, because so far manufacturing jobs have been contracting, I think, for 6 months straight.
For now, I understand, but
which is the first time since 2021 that's
services too. Services employment in the PMIs are contracting. Actually, relatively large contraction, not like 49. But anyway, I don't know. I'm gonna throw that out there, that I don't know if I believe that, but I know that it's a thing that could happen.
Yeah, and it definitely is something the White House has been talking up. I mean, I loved it the night before the last jobs report. Trump was at a dinner with a bunch of tech people and got asked about the labor market. And he's like, oh yeah, a year from now, the data will be real. And I thought, oh, there's an under on tomorrow's payrolls, because the president sees the data the night before. But I mean, I think they were, and I mean, to be fair, any major policy that you put in place will take time to have its full effect. So it is possible, but it's yeah, I'm not holding my breath on it. I mean, a well-designed tariff policy, I think, could get you there. I'm not sure this fits under it, but yeah, but that certainly is something to watch. And and also the amount of uncertainty around the policy, that has to be slowing down any kind of long-term adjustment, like onshoring. Like, if you don't know if these are going to get struck down by the Supreme Court in November, like, you're not moving jobs here. So we're not at that phase of this policy yet, but I mean, it's possible. And there are industries that are favored that probably will see some job creation. It's just there'll be disfavored industries that will destroy jobs. So the net effects.
And just to make it even more complicated, we used to think, perhaps we still do, that tariffs are an inflationary impulse, but inflation is measured as a year-over-year change. So, okay, prices go up, but then move a year out, and then now it doesn't look like. Or tariffs are so large, companies sense they can't raise prices that quickly, but they can raise prices more quickly than they would have incrementally for the next 3 to 5 years. So you could also make an argument that the inflation from tariffs is not a one-time impulse, but a multi-year impulse.
No, I agree. I think Powell made the point. It's like, one time doesn't mean all at once.
Right.
And looking at the data, and actually for the Fed, the thing that they're worried about, inflation getting stuck at this above target level, for them, it's actually worse when it gets spread out, because it's not like consumers are sitting there like parsing out, here's the tariffs and it'll go away and this, that, and the other. So, I mean, it does look like that this is going to be a drawn out adjustment process for a lot of different reasons. But, I think a lot of we'll get a new round of forecasts from Fed officials this week. And I mean, like 2% in 2028, I think, is probably where I would expect it to show up. I mean, it's going to get close as it goes along, but these, it's not, we're not going back to 2% right away. Like, this really kind of derailed the, like, say we got the soft landing and we're done with this. So.
Also, prices aren't coming down. Right.
So inflation coming down, not the price level.
No, of course. I understand. But like, the political argument that didn't work for Democrats was inflation's coming down. That was actually true, but prices were not coming down. Prices are higher. Yeah.
Right.
So, that slows down economic activity too. And that can be extended, right? It's like, that has to get digested. So it's hard.
So is the Fed between a rock and a hard place right now? I mean, it's got a softening jobs market, which normally you want to be supportive of, but inflation is sticky and it's above target, and it doesn't seem to be showing signs of dropping down. I mean, and here they are, they're going to cut. it seems. I mean, the consensus, 96% is a 25 basis point cut. Last week it was 90 with a 10% chance of a 50 basis point cut. That's obviously come in now, but I think we're all in agreement. We're going to see a 25 basis point cut here, but we're still seeing sticky inflation. And I'm sort of curious, like how does the Fed see this and navigate through it when they're going to be doing something to potentially increase inflation? And therefore, if they're forecasting we're going to get 2 or 3 cuts this year, but now the readings, I mean, it doesn't happen that quickly, but the forecasts have to start to take into account the fact that their policy is now becoming inflationary. But of course, the jobs market, they've got the dual mandate, and now the dual mandate seems to be putting them in a tough position.
Yeah, no, I mean, this is the trickiest setup for the Fed. It's mandates in tension, and they talk about they've got, there are downside risks to employment. I mean, the labor market is still in a pretty good place, but it's not pointed in the right direction. So there are downside risks on the employment side, and they could be big ones, right? A recession could do a lot of damage. And then inflation has been above target since 2021. And it is not like, you cannot look at these data and be like, oh, we are making progress towards 2%. Last year, when they started cutting, they had made a lot of progress and hadn't banked it yet. And the rate was still pretty high. And so, but the argument, this will not be a happy Fed meeting. They are going to cut because they are worried. Right. It's so interesting watching market reaction. And again, I can understand why, like, they like lower interest rates, but it's like, they are not cutting for a good reason. This is not like, they are very concerned. And as they cut, as you were saying, that is not going to help on the inflation side. And so and I think the other piece of it, I mean, like, the other thing about when the dual mandate's in tension is it's really complicated how they come down on what's the right thing to do. Like, we shouldn't be surprised to see dissents. We shouldn't be surprised to see a dot plot, like with that kind of looks, even more scattershot than usual, because you have to, make forecasts, think about risk scenarios, and then kind of like assess which of these two is the bigger problem. And I mean, honestly, I can come up with arguments for a 50 basis point, a 25. I think holding right now, given the labor market data, like doing a little bit makes sense. But I definitely think a message from Powell could be, hey, we took a step today and we're going to keep watching these risks because they're both really important risks that we're facing. And next time, it might be that the inflation data is what's got us more concerned and we hold. Like, to me, this does not feel like, oh, we're ready to go another percentage point off of and I think particularly the markets, like, I think the Fed and the markets are probably close to each other for this year. Like, there'll be 2, maybe 3 cuts, like something like that. But for next year, the markets seem to think it just keeps going. And this Fed, and then we'll talk about the threats of independence to the Fed, but like the Fed that will be voting, like, I think is going to be much more cautious in their thinking for next year, because it could be like, hey, we get the labor market steadied up, and then we need to make sure we keep in a restrictive place to get that last bit of inflation squeezed out, which I don't feel like that's kind of the market's thinking on this. They're just like, here we go, we're cutting rates. But I actually think, and it's probably appropriate, I think the market are going to totally ignore Powell on next year and the forecast, because you're going to have a change of leadership. We could have even bigger changes than that. And there's a lot of data between now and then. So I don't think the Fed is going to be able to convey the caution that they think is appropriate, but we'll see.
So if you were looking at these data in a vacuum, you still think that starting to cut here would be the right choice, and that this is not political pressure that's exerting some influence?
The labor market data is sufficiently worrisome. I mean, if we had some sense that like it was stabilizing at a lower pace, as opposed to, we've seen some pretty a progression since the spring of slowing. I just, at this point, going in and like what they call the insurance cut, just taking a little bit out of it, because we really have gotten a drumbeat of data that at least suggests that the risk is there, that things are going south. But again, I don't think the data say we're a percentage point too high. We're a percentage, or as the president would say, 3 percentage points too high. Like that's not the case. But I think there is a risk there that that one should adjust to, because again, once the labor market gets going,
that's kind of
in the wrong direction, it can really start moving. And then for the Fed, it's too late. Like their tools are not that powerful, like to stop a recession. So I think it's appropriate. But I think you'll hear from the Fed more about the inflation risk. And again, like it's a cut, but it's a bad news cut. This isn't a good news cut.
Yeah.
Last
year's cuts were the get really long. This is all good news. We're cutting because inflation's coming down and we're growing.
Right.
I mean, if you recall, not too long ago, PCE, the Fed's target was 2.1%. Not target. The PCE was 2.1%. Target's always been 2. It was there. It was like mission accomplished in lowercase letters, but
yeah.
Yeah, I mean that was on total. Core hasn't quite gotten down there, but but we're not there anymore.
Core was
it's moving
like 259. Like it was looking pretty good, you know.
Yeah. No, and we're moving in the wrong direction. And again, I think there's a very good case. Like if a lot of it's tariffs, and at least some of it is, to look through that to say this will be temporary. I guess to me, what's been most disconcerting is in some of the core services, particularly outside of housing, is just not making progress. And there could be some tariff effects in there, but I think it's more an issue that we carried into this year was just that part of service inflation, which is an important part of it, has just been sticky. And that, to me, that's the red flag. And again, the longer we stay at a higher level, I think people, businesses, family, they're going to, code that into their decisions. Why wouldn't they?
That's why it's so insidious. That's why inflation is so insidious, because of exactly this.
Right. Okay, so I haven't looked. I'm curious though, if you guys know, like what has happened with food and housing inflation. I haven't had a chance to look. Those are 2 areas that I know people feel the most or care the most about. Any thoughts?
Right. So on the housing, so the shelter inflation, that's actually been an area of progress, right?
Okay.
Affordability is still absolutely a huge issue. So house price levels, apartment price levels. But in terms of the month over month price changes are now much closer to where they were before the pandemic. So it took a long time to get there, but that's actually a big piece that'll keep bringing it down. I think on the food inflation, that was not a good part of the last inflation report. And I think we're going to hear and see a repeat of some of the concerns that came up, in the under Biden, is that we had coffee has been up and beef and some of it's tariff, some of it's just, the weather and supply, there's lots of issues there. But it's another one where, it's showing up in the data. And the immigration piece also is very important for some of the fresh fruits and vegetables.
Keep costs down when you don't have people to harvest.
Yeah, so I have a feeling food is going to rear its ugly head again as being a big concern. And the other thing that has been really striking to me, so the Michigan survey put out their monthly or their early monthly numbers last Friday, and people are so pessimistic. We are back in this just sentiment numbers that are historic, recessionary type numbers again. And you can see on this inflation piece, when they ask people, how are you doing relative to last year financially, and ask them why, the citing higher prices is just still really high levels. So, I mean, the whole prices have gone up. and this, we've continued to have higher, inflation than normal, and people have noticed, and they are not, like, this is a real stress on them, and it's gonna, and I mean, as the labor market cools off and wages have moderated, and that's gonna be, even if we don't have like inflation really taking off, it eats into slower wage growth, and then you're really not getting ahead. So we're not, I think people remind us, like, it matters, like 2% versus 3% inflation, it adds up over time.
Matters a lot.
Right. And it's, people feel it every day in these things. And just, Nate Silver put something out on Trump's net approval on these issues, which, started very high for immigration, the economy, trade, and inflation, all started, somewhere between +5 and -5 for net approval ratings. And, on inflation, he's now -30, and on the economy, almost -16. Like, people are feeling it, and I feel like that's a direct reflection of those sentiment numbers that you're talking about, that he came in saying he was going to fix these problems, and they clearly have just stagnated.
People don't like inflation, and it wasn't necessarily partisan to vote the other way. It was just that they didn't want inflation.
For sure, yeah.
One thing I wanted to point out, I was looking at the number just to make sure I quoted it right. So, we have this problem. Well, some people believe we have a problem with the way we measure shelter inflation with owner's equivalent rent and blah, blah, blah. It's really lagged. Do you remember those conversations? And the BLS put out this new thing, the new tenant rent index. So it actually looked like they were it looks like they're setting up a replacement for how they measure shelter inflation with their index. But I'm just going to say this. Q2, so it's quarterly, it was down 9% year over year. So if you're looking for maybe some positive news on, as long as that's not recessionary, if you're looking for positive news on possible core inflation, overall a headline too, but core as well, then maybe the shelter indices will come down faster. That new tenant index actually was pretty prescient. A little, slowly, but we were kind of in line, and then it just fell. So I don't know how that index is too new and too black boxy to know if it means anything, and I can't tell you it's the lowest in 15 years. It's a brand new index. It's like a year old. So of course it's still low, but I'm just telling you, if you look at all these charts of inflation, how they're measured, whether it's the CPI or PCE, owner's equivalent, all these ones, they all look the same. They do this little like too high coming down. The new tenant rent index went like this. So
wow,
just something to consider.
Yeah. Okay, so let's shift gears a bit, and let's talk about Fed independence. Not something we have really found ourselves talking about much in the past or thinking about too much. Sort of seemed like the kind of thing where there was a lot of bipartisan consensus that the Fed needed to remain independent of politics, regardless of, people complain a lot, certainly in the first Trump administration that it got more vocal, but that's always been a consistent precedence, complaining if the Fed isn't doing exactly what they think they should do. But the political pressure this time around for cuts has been significant. And of course, we're dealing now with the situation where President Trump has attempted to oust one of the Fed governors, Lisa Cook. I don't know that it's even worth getting into the nitty gritty of it, but it is unclear if what he has done is legal. I think there was a Supreme Court stay of something, so she can't, I think, continue to serve right now while the case.
Oh no, she can.
Oh, she can. Okay.
As of right now, unless they've. It's actually not clear who's going to be voting on Wednesday, but the first court said she can stay in, but the administration is. We'll probably hear from the appeals court tonight, Monday, as to whether she's going to be in place as her case continues. Right. So this whole question about whether she gets to keep doing her job, and I think the thinking is if the appeals court this probably will eventually end up with the Supreme Court. Even if she's just told she can't continue in the role until the case is decided, that'll be a pretty big swipe at Fed independence. So,
So what
we had a little bit of this, Dave, in 2018, right? I mean, it's louder now, but this Fed independence issue with Trump. I know presidents complain about interest rates. It's not like that new, but maybe it was just because it's a new world with social media. That was the loudest I think it had ever been until then.
Yeah.
And I don't even think this is a left and right issue, honestly, because I have seen calls from the left as well to say, Congress should have much more of a say in Federal Reserve policy, that we should have more oversight, and that interest rate policy is not just an economic decision. It is a political decision as well. So I've seen good arguments both ways, but obviously I think I don't know. I don't even know if I'm ready to say we've done really well with an independent Fed, because quite frankly, if you look at the economy over the past couple of decades, the bubbles and bursts have hurt people really badly. I think the wealthy have done really well with an independent Fed, but I don't know that I'd go so far as to say that politics wouldn't have helped to a certain extent. I don't know, but I assume, Claudia, you are very much a Fed institutionalist, and you want to see the Fed remain independent and above all of this.
Yeah. Well, it's, I think about the discussions with the Fed, and also I draw some parallels, discussions we've had about the Bureau of Labor Statistics, right? I am all for improving institutions, making them better, making them more accountable, stronger. That is not what this discussion is about. I mean, the administration is very clear. The president has, I will give him credit. He is very clear about what he wants, right? And it is in public, and we can all see it. The president thinks the federal funds rate should be at 1%. And frankly, I think they've used every tool of the Fed to get the longer rates down too. I don't know if this is just about the funds rate. But so that's not the Fed as we know it is not going to take the funds rate to 1% in the coming months. That's just not happening. But if you had a different Fed, well, then maybe you get that. And so to me, Fed independent, it can mean a lot of things, and the Fed does a lot of things. So some things are, there are better arguments about shielding it from politics or not shielding it. But if you just typically Fed independence boils down to who controls the interest rate, who sets the federal funds rate. Operationally, it is going to be the Federal Open Market Committee, but who's calling the shots? And presidents always have some influence, right? Yeah. They nominate members of the board, they nominate the chair, there's all, and Congress, reviews them, confirms them. So and the Fed has to report to, so there's the Fed is not free of politics, but what it's free from is the day-to-day, the operational, what do you do with rates? Let's base it on the economy, as opposed to the midterm election is in about a year. This is prime time in the electoral calendar to be messing around with the central bank, right? If you wanted to bring rates down. And so this is, to me, that's just who's in charge of these interest rates. And what is different in this Trump administration than the first Trump administration is they have moved from words, here's what we want to do. I think for credibility, it is harmful to have the president calling the Fed chair a moron, on a large platform. But these are words, these are threats, but then it started to move into actions. And some of it was just dipping the toe in the water. I'm going to show up at the Fed, and we're going to tour the construction site that I might fire you over, and just tense things. And then really attempting to fire a Fed governor for alleged offenses whose term goes till 2038. That went, now we're in we're acting. And they, today the Senate will finish the confirmation for Stephen Meyer, and he'll come up, which again is legit. It was an open seat. It opened up a little earlier, but totally normal for president to nominate. And they moved it fast, and he's keeping his White House job. This is the first time since the 1930s that we're going to have someone cast a vote that is in the administration and at the Fed. There's some weird circumstances to it, but we're not even Like the administration is not even trying to play along with Fed independence. They're trying to take control of the Fed. And I mean, frankly, if the Supreme Court gives the administration what they want, and they have asked that the president can define for cause what reason without judicial review. So President Trump has determined that Lisa Cook for cause should be removed. Well, guess what? If he can remove her, he can remove Powell for the building. He can remove them because he doesn't like their haircut. I mean, like, it won't matter at that point. It's not, they're at will. And then you have, the board in DC can be Trump people. And if he puts someone in, they don't do what he wants them to, he just fires them and puts somebody else in. Like, we could have Fed chair sweepstakes like over and over and over again. Like, I mean, like, it'd be like the IRS that's gone through like 5 commissioners already. So I think that's I'm really concerned. And then we're in a world of ultra low interest rates, potentially yield curve control, inflate. Like, it starts to get really weird. And it's hard to know how much time to spend like running through those scenarios, but it kind of feels like the Fed's going to be a very different Fed this time next year, if not sooner.
Ophir, what do you think? How do markets see this issue so far? I like, from my perspective, I really haven't. It hasn't even seemed like a blip on the radar. What do you think?
Not yet. I would say the markets, if we're going to anthropomorphize, the market's personality has changed. Used to be very forward-looking, risk-bearing, like really ingested these ideas of large risks. And then always, when the risks come, it wasn't really ready, and that's why we have these busts. But the market to me reflects a change in like society. Like the market wants the market wants to do YOLO trades too. Not the market participants. The market wants the YOLO. And so anything that offers a potential for YOLO, which this could, I mean, there's lots of things that could come out of this, but one very real possibility is like just hyperinflation and chaos like we haven't seen in this country. Whatever, like Argentina. I don't know, whatever.
But it'd be great for the markets, right?
Yeah, but that's what I mean. Like
in the very near term.
So the market's behaving like a YOLO 0 DTE trader, which is usually not. Usually the market would be like, oh, I don't like that. I mean, just think about long-term capital management,
right? Which
of course in retrospect was tiny, right? But it was big then. The market did not like that. Right. It almost created a crash. It's easy to forget 1998, but they had names for it, the Asian contagion. I mean, the whole thing, it was a big deal. This is worse than that, possibly. And the market's like, yeah, man, let it rip. So I don't really know. This is not, and people will laugh for watching this. This isn't the market I know. It just isn't.
You shaking your fist yet?
No. I'm not. One thing I've definitely learned, not just in the market, but in life, people should talk about market and economics. I don't fight what's happening. I accept it and try to react to it. That's the only thing you can do. Mm-hmm. So I never shake my fist, maybe at myself. I'm like, oh, you should have done better. But I'm just letting you know, this is not, there was a version of the world not too long ago where this was a down market, where Fed cutting into job weakness with inflation was actually bad news. With possible Fed independence issues and the Supreme Court possibly determining the law of the country, right? Of just like, everything, doesn't just have to be the Federal Reserve, just anything. Like courts don't even matter anymore.
Probably an argument to make that a market acting that way, which I think a lot of us would see as far more rationally, would be good. Right? The wealth, the contraction from that could help to tame the inflationary
The market I know would be lower, and we would not have a 14 VIX. That's the market I know. It's not the market we live in, so this is the market I'm trading, and I make money in this market too. But it's not the market I know. It's not the market I know. It just isn't. And it's okay. It's not the Fed I know. It's not the president I know. It's not the courts I know. It's not the immigration policy I know. So.
All right, so let's just think through this, because yes, there are lots of scenarios that one could probably come up with for, what the repercussions or possible paths for all of this to follow. But let's just imagine a scenario in which Trump gets his way, that the Fed by the middle of next year has cut interest rates to 1% and is dedicated to holding them there. What do you think? Like, I mean, in my lifetime, as you're sort of getting at, Ophir, like the Fed has always been at least a somewhat, if not behind the ball, a somewhat rational actor, where the interest rates are commensurate with like the economic situation, or it's always trying to revert back to the mean. But this feels like it would just really send us off in a direction way away from the mean. What would it actually do?
I think I'll let Claudia close it, because what she's going to say is going to be smarter than what I'm going to say. I'm reminded of one thing, which I brought this up on the podcast before, and I hope it brings some semblance of relief. The U.S. House of Representatives, and I know that 94% of incumbents win. I got it. The entire U.S. House of Representatives gets rolled over every 2 years. The whole thing.
Mm-hmm.
The whole thing. If that happens and we have hyperinflation, the House will flip big, 100 seats. I mean, if we have actual reacceleration,
actual hyperinflation,
forget hyperinflation. What if CPI goes to 4.7%? I don't know if you consider that hyperinflation, but 4.5%. Again, many people who voted out the old administration, no pun intended, did so not because of political positioning, but because they blamed the administration in power for inflation, and they don't want that. And this other one was saying, well, I'm going to change it. And they're like, I'll take that. You can talk about freedom and blah, blah, blah. I can't afford groceries. If that goes both ways, it goes both ways. You can see it flip again. And all of these arguments about redistricting and all these things, it might not matter if we get inflation back at 4.5%, because everything's flipping. I'm just going to point that out, that it's kind of the bastion of hope I have for the United States is like, hey man, the House rolls over every 2 years. The whole thing. So
fair. So a political whiplash to
something we know
economic consequences.
Yes, and inflation is the thing. We've always known the economy is the thing, right? It's the economy stupid, but it turns out it's inflation stupid. At least this time around.
But I think that's really like what kind of inflation would we see from a 1% interest rate under these economic conditions? Do we have any sense?
Well, and I mean, I think the other piece is the inflation will come, but not right away. Right? I think the first thing you get that YOLO economy. I mean, it's the sugar rush. So interest rate sensitive sectors, and you know what? They might be right. In that there's, a technology boom getting going and we need to there's a case. It's an outside case. And it would really depend how aggressive one were in bringing down interest rates. I think they'll end up being too aggressive given the opportunity. But you could see next year as really being the sugar high. And interest rate sensitive sectors firing on all cylinders. And so it's not, I think it's a little bit we had all this, economists talk about it, the tariffs are going to cause inflation. And then we're all like, where's the inflation? Where's the inflation? It's like, well, look, it's coming. It takes time to work. It's these costs are real. They're coming through. So I think you'd probably see next year as, they get their 3% GDP growth, their 4% GDP growth, housing starts. And so for a little while, it probably can look like it's a good thing. And then the inflation comes, right? And it's in sectors. I mean, think about, again, there's so many moving pieces, but you're an interest rate sensitive sector, with housing construction. And supposedly they want to have a housing emergency declare one. Scott Besson has talked about this. I mean, anytime they say emergency, it's like, oh my goodness, we're going to go grab powers we shouldn't have. Like, I figured that's how they're going to take the Fed and justify it. It's like, we have a housing emergency, so we have to bring the interest rates down. But it's like, oh, but you've got immigration policy that is starving this sector of its workforce. And you're going to so we could see a lot of really problematic policies that have been put in place kind of all crash into each other if you get, the interest rates pushing it. But I think it would take time to see the inflation creep up. And then the cleanup of this, recreating an independent Fed, getting inflation back under control, what? So it's like you'll pay for it down the road. I don't think it would be clear before the midterms. It'd just be a big mess. But there is a chance, at least initially, it will have looked like a really smart thing to do. And it's not like the Fed's got tons of people defending it, right? Like it has a, so it'd just be messy. Very messy.
Okay, fair enough. One last thing I wanted to ask you both about, which is a new idea this week, as we sometimes get new policies on social media. Trump posted on Truth Social, subject to SEC approval, companies and corporations should no longer be forced to report on a quarterly basis, quarterly reporting, but rather to report on a six-month basis. The EU requires 6-month reporting rather than quarterly. So what do you think? He says it'll save money, allow managers to focus on properly running their companies. I think he alluded to the idea that the Chinese perspective tends to be extraordinarily long-term, and the U.S. suffers from short-termism, and which is, I think, an issue in terms of short-termism is one I totally agree with. And
there's a little irony in what you just said, but yes, go ahead.
Yeah, for sure. But is this the way to do it? Do you think that this could impact transparency? Do you think this hurts retail investors more than institutional? This seems like a real, the kind of policy he could easily put in place. He has said it. He would go to his SEC chair. They put that rule out. This is the kind of thing that can happen relatively quickly. What do you think of it?
I have a strong opinion. I think that it won't change anything, and the companies that go semi-annual, their stock prices will suffer. That's it.
So then they probably won't go semi-annual then, right?
That's why I said I don't think it'll change anything. Yeah. It's just
it's optimistic.
Well,
I think you're probably right. Yeah.
I don't know if it's optimistic. It's just, it's when we as investors know less, we pay less. That's it.
Yep.
Now, if you're talking about the long arc of the societal change to the markets going semi-annual, I don't know. But in the near term, how about this? Maybe I'll look like a fool for saying this, and this is getting recorded. It's okay. I'm wrong all the time. So it just adds to my list.
We're all willing to take that risk. Yeah.
It's fine. Apple's going to report how they're doing every quarter. So is Amazon. So is Alphabet. So they just are.
Mm-hmm.
And so I don't see that changing. I will tell you that it is true that quarterly reporting is extremely burdensome for small caps. It just is. It's really expensive.
Mm-hmm.
I mean, the SEC's these requirements. It's okay. It creates a fair and orderly market, but man, those SEC requirements are brutal.
Yep.
For like a $300 million company with like $50 million in revenue, the quarterly reporting is brutal for them. Brutal.
Yeah.
So. But I think
maybe this leads to a more vibrant mid cap and small cap market.
I think money will flow out of them if they don't report quarterly. I still have the same belief. Just
okay.
Yeah.
All right.
Yeah.
Interesting. Well, again, as always, thanks to the both of you for taking your time. I always love these conversations. I find them fascinating. We get lots of people that tune in, so it must be doing something. We must be doing something right. It's I really appreciate your perspective and insights. These are complex issues. I'm really glad people are interested in tuning in. I think when we started this, we talked about how people tend to care about macro for just a few months at a time, and then really don't want to hear about it anymore. But I'm really happy to say that I think that we've proven that's not exactly accurate, and there is still interest, and it's just a super fascinating part of the political economy to be focused on and talking about every quarter or so. So again, thanks to both of you. Thanks everyone for tuning in and paying attention and subscribing. We'll be back next week, next Tuesday at 1 o'clock Eastern with Charles Allen from BTCS, a public company involved in cryptocurrency. So we're going to talk about a bit more of crypto regulation and crypto policy. But until then, this week I'm going to be in DC on the SEC roundtable talking about Reg NMS Rule 611, the trade through rule, and listening in to see if there are any regulatory changes coming down the pipe. So I'll report back about that next week. But until then, again, thanks everyone for tuning in, and thank you, Ophir and Claudia.
Great, thank you.